Welcome to FXCM's presentation on rollover. You may have noticed the roll column in your trading station. This column keeps track of how much rollover, or interest, has been added or subtracted from your account during this trade. Rollover happens because the two different currencies in your trade have two different interest rates. Therefore, when you buy a currency with a higher interest rate against one with a lower interest rate, you will earn rollover. When you sell the higher interest rate currency, you will pay rollover. Rollover is an integral part of trading Forex and can have a significant impact on your strategy. Every day at 5 p.m. Eastern U.S. time, all the open positions on your account are rolled over to the next business day. As a convenience to our clients, FXCM does this process automatically for all trading accounts. What this means for you, the trader, is a credit or a debit to your account for every position that is open at 5 p.m. Eastern Time. The amount of rollover, as well as whether you earn or pay interest, depends on the interest rates for the currencies you are trading. You can always find the current central bank rates at dailyfx.com. For example, the interest rate in the Eurozone right now is 4%, while the US rate is 4.75%. Because the Euro interest rate is lower than the US interest rate, you will pay rollover if you buy the Euro-US dollar. You will earn rollover if you sell the Euro-US dollar. Many Forex traders have strategies that actively pursue earning this rollover interest. This type of trading is called the carry trade and is especially popular with large institutional speculators such as hedge funds. You can easily see the effect of the carry trade in pairs like the Australian dollar to Japanese yen. Here's a chart of the Aussie yen over the past 10 years. Australia has one of the highest interest rates of the currencies we trade, 6.5%. Japan has the lowest, 0.5%. You can see the strong trend of Australian dollar strength as investors from around the world sold the yen to buy Australian dollars and earned the difference in interest, which is currently 6%. Now, 6% annually is a nice return, but nothing spectacular. But then you have to remember that many Forex traders are leveraged 50, 100, or even 200 to 1. This means that for a trader with, say, 20 to 1 leverage, 6% becomes 120%. So you can see the attraction in the carry trade. In addition, you have the potential profit or loss from the currency moving. In the case of the Australian dollar to Japanese yen over the past few years, as many traders have piled into the carry trade, the Aussie yen has risen significantly in value, so you could have seen a very large capital gain as well. Also, while this leverage has the potential to dramatically amplify your returns, it can just as dramatically amplify your losses. You can carry trade with any FXCM account. All you need to do is buy a currency with a high interest rate against a currency with a low interest rate. Popular currencies to buy and carry trades include the New Zealand dollar, Australian dollar, British pound, and US dollar, and to sell, the Japanese yen and Swiss franc. You can always view today's rollover rates in your trading station by switching the dealing rates to the Simple View. To change view, simply click on the Simple Dealing Rates tab at the top of the Dealing Rates window. Once you do this, look for the Roll S and Roll B columns. Roll S will show you the amount of rollover you will pay or earn if you sell one lot of that currency and have your trade open at 5 p.m. Roll B is the amount if you buy. This account here is a US dollar account, so if you buy one lot of US dollar to Japanese yen, you will have $11 added to your account balance at 5 p.m. today. The rate will sometimes change slightly from day to day to reflect current prices in the international swap markets. If comparing different FX brokers, I recommend taking a look at how much rollover you pay or can earn. Because FXCM is one of the largest Forex dealer members, according to financial data found on the CFTC's website, we have access to some of the best rollover rates in retail FX. Rollover can greatly affect your profitability, especially for carry traders, so getting the best rollover rates for you is a high priority for us. Now, how is rollover calculated? Here's an example using the US dollar to Japanese yen. When you buy US dollar to Japanese yen, you earn the rate for the US dollar, which is 4.75%, and pay the rate for the Japanese yen, 0.5%. So your net rate is 4.25%. Since you bought 100,000 US dollars, which is the standard lot size, you calculate 4.25% of $100,000, which is $4,250. To get the daily rate, all you need to do is divide this number by 365 for the 365 days in the year, and you get about $11.64 per day. You'll see this is very close to today's rollover rate for the US dollar to Japanese yen. There is a small difference because the rollover rate is determined by rates in the international swap market. Wednesdays are special days to watch for because rollover is typically tripled on Wednesday. This is to account for interest accumulated over the weekend when most banks are closed. Also, if there are any holidays for the currency you are trading, you may earn or pay multiple days worth of rollover a couple days before the holiday, but have zero rollover on the holiday itself. You can check for special circumstances such as these at dailyfx.com, down here on the monthly rollover calendar. If you would like to talk one-on-one with one of our FX specialists and learn more about the carry trade, just click on this link right here. Also, you can call us anytime, 24 hours, or email us at info@fxcm.com. For the latest in news, research, interest rates, and the rollover schedule, be sure to add www.dailyfx.com to your list of